Hello and welcome to Seeking Alpha Interviews. I'm Jane King at the NASDAQ Market site in Times Square. With me today, Brad Thomas, the editor of Forbes Real Estate Investor. Welcome, Brad.
It's great to be here. Thanks
yes,
so much.
Great to have you. So your latest writing for Seeking Alpha starts with, "It was not until I lost large sums of money that I developed a serious concern for saving it." So losing money, as painful as it is, can be a good teacher, right?
It is painful, and that's really what got me to my current career today. Is, I was a real estate developer for about 20 years and built shopping centers and a number of net lease properties throughout the Southeast. And, this thing called the Great Recession, it was great for a reason. And so I really feel like part of my duty today, my job, is to educate investors on how to make money. And of course, the number one rule of investing is not to lose money. Protect your principal at all costs.
Yeah, capital preservation. I remember one of the first courses I went through that financial crisis too, so that was interesting. So you've developed basically a scoring tool for REITs. So tell me about that.
Sure. Well, I've been covering the sector for a number of years, and I wanted to come up with a way that I could provide my subscribers and readers and just investors in general with a way to rank various REITs. There's over 200 REITs today, equity and mortgage REITs. So we've ranked about 140 equity REITs, providing a scoring system for them, really based upon durability. Okay. It's really more of I call it a toughness rating.
Okay, and durability, you mean to be able to make it through like a tough economic time?
Sure,
okay.
Dividend safety, balance sheet, all of those things that go into a company's sustainability and their ability to survive multiple economic conditions.
Okay, and then you also talk about Ben Graham. So he said, of course, classic. Anybody who's been in this business knows Ben Graham. That he had a willingness to work hard for small sums. So it really got my attention because I don't think people really do that anymore. I mean, I have a lot of friends who are like, I'm not working for that wage, but he really understood the value of work and just being active and doing things and kind of starting small and working your way up.
Sure. And again, I think it just really boils down to all of us fail. As investors, we all fail. If we don't fail, we're not really doing anything. So you've got to go out and take some kind of risk in the investing world. Ben Graham did take a lot of risk right before he wrote the book, The Intelligent Investor. Not to be confused with my book, The Intelligent REIT Investor. He went through very tough times. He experienced the Great Depression. And so that really helped develop a mindset for him to be a conservative investor. We also saw some of that failure with his one of his star students, a guy by the name of Warren Buffett. And Warren Buffett also went through some tough times when he started Berkshire Hathaway. That was a textile firm that was really losing money, and he basically decided to pivot into what Berkshire Hathaway is today. Even Donald Trump, as I write in my other book, The Trump Factor, Donald Trump obviously has gone through failures in his career. So all of us have gone through different failures in life, and it's a matter of how you move forward with that and learn from those failures.
Sure, and resilience. I mean, that's just so important to not just, crawl under your desk and suck your thumb, but to really kind of figure the situation out and move forward somehow. Okay, so you've done the heavy lifting on this, so let's talk about the REITs that you like. I know there's several of them. Which ones do you like right now?
Sure. Well, again, this goes back to durability. I really try to coach investors to invest in just the highest quality stocks there are, because we really, when it comes to REIT investing, you're buying real estate, so you're really wanting those rent checks to be collected for long periods of time, because those are obviously what drives dividend checks and dividend growth. So we look for those companies that have a long history of dividend growth, and they also have a very good future for dividend growth ahead. So we look in the rearview mirror, we look in the windshield, in the front, in the back. And so some of those companies that I like are those companies like in the retail space. We've seen Simon Properties, ticker symbol SPG. We all know the malls are just getting beating up. The whole Amazon effect, the number of department store closures we're seeing with Sears and JCPenney's, the fact that whether Sears is even going to hold on this year. There's a very good chance now. Last I saw was a 40% chance that Sears may not make it through 2017. So when you look at what's happening in the broader retail space, there is some concern. So what we've decided to do, again, going back to the Rhino rating, is look at those mall REITs that have the highest quality portfolios. We call them the A malls, as you sector them into A, B, and C type malls. So those high quality malls that Simon owns, they're in fact probably they have the highest quality malls in the whole mall sector. So we like that company. Again, that's been beaten down a lot this year, but that's created a nice margin of safety.
Well, yeah, and that's what I was wondering. Like, is this an opportunity, or is this just a business that's, going to be forever changed by internet shopping.
Again, going back to dividend growth, I mean, Simon has had a long history of dividend growth. They did cut their dividend in the last recession. I give them that, but they gave out shares instead of cash.
Okay.
Not the same thing, but that did show an alignment of interest with investors. David Simon is the largest shareholder, individual shareholder, so there's also a very strong alignment of interest there. But in terms of dividend growth for Simon, we definitely see a runway for growth. They've been able to maintain roughly 10% dividend growth every year over the last few years, so that's really strong. Another name we like, which is not as well known, is Tanger Factory Outlets. Tanger is ticker symbol SKT. Tanger is based down where I come from in the South. They're based in Greensboro, North Carolina. Tanger's been around for over 23 or 24 years. They really were the pioneers of the whole outlet concept.
Yeah. There's some up here.
There are. I mean, they're actually, Tanger now has a very diverse portfolio. They're actually up to Canada, all the way up to the West Coast. They are really the only pure play outlet center REIT. We do categorize them as a mall REIT because they have a lot of the same tenants that malls do, so we compare them to the mall REIT sector. But when you look at the dividend growth, again, going back to that quality metric, the Rhino rating that I use in my research, we look at Tanger has increased their dividends over the last 23 or 24 years. Ever since they went public, they've increased the dividend every year. Even through the Great Recession, they're the only mall REIT that increased their dividend throughout the Great Recession. They maintain very high occupancy levels, and their occupancy is around 97, 98% on average. When it gets closer to the holidays, around 99%. So it's a virtual zero occupancy model. There are literally people that, when there are some tenant bankruptcies they've had to deal with here recently, but they always have people to come in those and get those spaces leased up. So the outlet sector is definitely, and it's a proven model. It works in good times and bad times. And so, definitely Tanger is a name that, and they've been beaten down as well. So you now see that, that margin of safety reflected in the share price.
Okay, and then finally you write about talking to Uber drivers and airline attendants, and what do you learn from doing that?
That's what I love about traveling and coming here and meeting you today. I mean, just traveling all over is really good because I'm able to meet and speak with individual investors, and that's really the passion for my job is not as much the research. It is pretty boring, and it's hard work. But what I enjoy is talking to individual investors, helping them educate them in the world of real estate and how to create wealth in real estate. It only takes one share of stock to own a building right out the street, whether it's Vornado or SL Green or Boston Properties or Empire State Realty Trust, all over here in the city. So it gives the average investor, the average Joe or Jane, the ability to own very high quality commercial real estate.
Yeah, you can also get a sense of just kind of consumer confidence and how mainstream people are thinking about shopping and so forth too.
It is, and obviously with the book that just came out featuring our president, I always have to talk about the political side too, which I don't mind. I mean, I think it's really important to recognize that our president ran on a business ticket, and so it's good. I've been able to weigh in on kind of his business philosophy, kind of what drives him, the DNA behind him, and how he's been able to build his wealth in the world of real estate. So that's been really interesting to talk to people about as well.
Okay, thank you so much, Brad, for joining us today. Brad Thomas, editor of Forbes Real Estate Investor, also Seeking Alpha contributor. And thank you as well for joining us on Seeking Alpha Interviews. Have a great day.